So in our last session, I asked the question, what drives the value of an option? Why was that Apple option $14 or $15? And we said these are the inputs, and I showed you 5 of the inputs in the Black-Scholes formula. There are formulas that adjust for dividends, and the Black-Scholes formula does adjust for dividends. And remember, when we talked dividends earlier, it's important because when a firm pays a dividend, the stock price falls exactly by that dividend amount. So that means if you're buying calls and you're hoping the stock price goes up, paying a dividend is going to hurt you. If you're buying puts and you benefit when the stock price falls, then them paying dividends helps you. So that has to be adjusted into the formula. And so that was something that the original Black-Scholes had left out, but has since been added back in. And you saw when we looked at the Chicago Board of Option Exchange, their formula asked information about dividends. So let's start with each one of these. It's not in order. So my first one is X, RK, however you do it. So the strike price. So let's think about the strike price. So the strike price that's the price you have to buy the asset at, or it's the price you get to sell the asset at. So for Apple, if Apple's currently trading for $270, if you're doing a call and your strike price is $280, then you get to buy Apple for $280, even though it's currently trading for $270. And if it's a put, you get to sell Apple for $260 if you do the strike at $260 when it's trading at $270. If you think about it, the higher the call option strike price, the less valuable it is. To me, to have the right to buy Apple for $270 is far more valuable than having the right to buy Apple for $300. I'd much rather have the right to buy it for $270. So the higher the strike price for a call option, the lower the call option premium will be. What we pay at $14, you'll notice that in, let's go back to Yahoo Finance. Again, do Apple. Should have left Apple up there, but I was checking the market. It's a pretty wild market today. So we go over the options just to show you again. You just go into options, and again we'll do July. So if we do July options, just give it a little time. April 24th is just a few days away, so those options are just not that interesting. So let's go out to July. We go out to July. I keep getting Alcoa, sorry. I feel like I'm typing the whole thing, but my computer ignores it. So for Apple, we go out to July. So you notice that if the strike price is $270, the call option is $480. It looks like it. So these are different numbers than what we saw before. I don't know why. I don't know why we switched there. Let's try switching it again. These numbers don't look correct to me. Sometimes I do this. I want to go out and just do some option trades now because the prices look wrong, and then I discover that Yahoo Finance hasn't updated it correctly. So there is an intuition to this. I'm somewhat using that intuition now. So, all right, so the 285 we saw before is now at 15. That makes me feel better. It was way too low when I brought it up this time. So, all right, so an option with call option with a strike price of 270, you can see it's a lot more expensive than a call option with a strike of 285 versus 300. And then you get up in these really, really high numbers. And what's the chance Apple's stock price is going to be $410 in just the next 3 months? Something radical would have to happen to the company. So that's only 19 cents. And then you get out in the real extreme, 500s as far as it go. There's a lot of contracts there. There's 131 contracts there. So there's people who are actually thinking about that, but very, very unlikely. All right, so that's the first one. The higher the call option, the higher the call option strike. Higher call option strike, the lower the value of the call option. Put option is exactly the opposite. The higher the strike, the right to be able to sell Apple at $280 is a lot more valuable than the right to sell it at $260. So the higher the strike, the greater the value of put options. And we can see that again with Apple. You notice as these are their put options here, the put options start halfway down the page. There's their puts for July. And you notice as the put option strike price, here's the strike prices, as it increases, the higher the the price, the more valuable the option. All the way up. And then you notice if Apple's currently trading for 270, you get into this area where you're actually able to sell it at a price greater than what it's currently trading for. And then you get it these really, really high prices. Here it goes up to 460, and you can sell that for $135. If you think Apple's stock price is going to fall, you know, you could sell this put option to get $135, and you know, you'd be somewhat lucky if you think it's going to fall. If the price rises, you're going to be in trouble, and we'll talk about that more when we get into the nature of puts and calls. All right, so there's the X. The next one is time. That's the T. So time. This one's easy for both puts and calls. More time means more value to the option. So let's go back to this 285 that we're looking at on the call option. The 285 call option had a price at $15. If I change my date to January 2021, then that 285 is now much more expensive. It went from $15 up to $26. The exact same thing with the put options. So time is very, very simple. The more time you have, the more valuable, and that just makes sense, right? If you buy an option on anything, whether it's real estate or on stocks, to say, hey, you have a right to buy this house, pay me $10,000, you can buy this house for $500,000 anytime in the next 3 days, versus you can buy this house for $500,000 anytime in the next 3 years. Wow, that second one's much more valuable to me. No one else can buy that house, have the right. If real estate prices all shoot up and these houses are now worth $700,000, $800,000 and I've got the right to buy it for $500,000, then having that 3 years is really valuable. If the real estate market crashes, then I can just, whatever I paid for that option, I can just let it go to zero, lose my money on the option, but I don't have to pay $500,000 for a house that's only worth $300,000. So time always helps you. What we talk about with options is something called time decay. What that means is this 2650, it's going to decline just because of the passage of time. Because why in the world would you want to buy? Well, let's assume this option expires in 3 minutes. Apple's trading for $270, and the market closes in 3 minutes. Your chances of this being a worth to you, if it's trading for $270, there's no way this be worth anything to you. Be probably trade for less than a penny. Yeah, it's possible it could shoot up right at the end of the day, but highly unlikely. And so as you get closer to expiration, the time value, the time part of this will decline over time, and you have what's called time decline. Just the passage of time causes the value of options to drop. We'll talk about time value later. I'm going to actually calculate it. And we'll see that the difference between intrinsic value and time value. Those are two different values, and we'll actually calculate those numbers here probably in our next session. We'll see how we do today. All right, so there's time. The next one is the underlying security, the price of Apple, that 270 for Apple. And the nice thing about here is for S goes in the exact opposite direction of X. Remember, with X, the higher the strike price, the less valuable the call option. But with S, the higher the underlying price, the more valuable the call option is. So if you have a right to buy Apple for $270 and the stock shoots up to $300, that call option is going to be worth a lot of money. The put option, exact opposite. The higher the underlying price of Apple, the less valuable the put option is. So both of these go in the exact different direction as strike. All right, the next one is volatility, V. So volatility is not how volatile the stock price has been, but it's how volatile we expect the stock price to be going forward. You'll notice in Yahoo Finance, they have something called the VIX index. If you go up to the top, here's the VIX. It's at 45. What the VIX is, it's It's the volatility the market assumes on options on the S&P 500. And so when the VIX is 45.65, the VIX is on the 3-month option. Essentially, the market is telling you, the option market is telling you, they expect the S&P 500's annual volatility to be 45.65% over the next 3 months. So they annualize the number, but that's what they expect. That's a really high number. The normal number for VIX is in the 15 to 18% range. Right now it's at 45%, and that's because obviously we're in a very volatile period right now. It's been over 100 in the past. If you look at VIX and actually download it, it doesn't get over 100, but one of our board members at the mutual fund where I worked, one of our board members was a professor from Rice University, and she actually created the VIX with another professor, and she sent me the history of the VIX even before it's been recorded, and showed back in 1987 when the S&P 500 fell 23% in one day, the VIX actually went higher than 100%, which is a really bizarre number. We've been up in the 80s here. You know, if you look at this number, we got up in the 80s in the last few weeks. Probably intraday. Let's see. So there's, I saw an 82 in there. So there's an 82 on March 16th. You can see we've been trending down since then, but 82, that is an extremely high VIX. And look at it intraday too. That's a huge day for the VIX. Just incredible stuff. So volatility is the expected volatility of the stock in the next, until between now and the time that the option expires. If you looked on that CBOE site I showed you for pricing options, you can actually calculate the implied volatility of a stock and use that in your analysis and compare it what the historical volatility has been and make a decision. When volatility is high, high volatility makes the value of both calls and puts be higher. So volatility is a lot like time. The more time, the more valuable an option, the more volatility expected, the more valuable the option. Both of those cause option prices to go up. So when you saw the VIX is at 45% right now, what that means is options, call options and put options on the S&P 500 are probably 2, 3, 4 times more expensive today than they normally are. The interesting thing about volatility is the only thing we don't know with pretty clear precision when we buy the option. When we buy an option, we know what the strike price is. We know when the expiration is, so we know time. We know what the price of the underlying is. We know what interest rates are, and we have a pretty good idea what dividends they're going to pay because firms don't change that much. That may be a problem right now with COVID-19, that firms may be changing their dividend very quickly, so dividends may be a little bit of unknown, but it's essentially fairly well known for most companies. So volatility is the one forecast number that you need. And so when you're valuing an option, that's an important consideration. Now, this is the exact opposite of what we saw with the capital asset pricing model. Remember with the capital asset pricing model, the more risky something is, the higher its beta, the less valuable it is. But options are the exact opposite. The more risky, the more volatile an option, or the underlying that the option is on, the more volatile, the more valuable the option is. Option pricing theory and options themselves are a very different world of finance than you will find in normal finance. Normal finance is discounted cash flows, higher discount rates give you lower valuations. Options are a very different type of animal. That's why I say it's so important to know, are you in the CAPM world, which is just discounted cash flows? Are you in the option pricing theory world, where volatility, huge potential payoffs with a high percentage of, a chance of nothing, getting nothing? It's a very different world. I actually think a lot of these startup tech companies are more like options than they are like stocks. They're trying to value them the way we valued, in papers 3 and 4. Some of these companies, it just doesn't make sense to value them using the capital asset pricing model and dividend discount models. Option pricing makes more sense because there's a high probability they're going to go out of business, but there's a small probability they become the next multi-billion-dollar company. And so that's a very different type of analysis. So I think volatility is an extremely important conceptual point. And then interest rates are important. Higher interest rates increase the value of options and decrease the value of puts. Now, why is that? I'm not real picky on this part. Right now, it's not that big of a deal because interest rates are so low, they have almost no impact. But when you buy an option, it's somewhat as an alternative to buying the stock itself. But it's a lot cheaper to buy the option than it is to buy the underlying security. And so you're less cash out the door. So higher interest rates means that increases that value of that option because you don't have to put as much money out the door. Same thing with the put option. Rather than selling the stock today and getting that cash today that you could invest at a higher amount, you delay that, and so it actually hurts. Higher interest rates actually hurt the value of puts. But I'm not that real picky on that. That's something you'll probably have to look up anyway. Dividends, we'll ignore it for now, but dividends are important. If a firm pays a higher dividend than expected, the stock price will fall, and that's going to hurt call options. It's going to help put options, so you need to make that adjustment. All right, so we got interest rates. That's the I of vid and Texas videos. And then you have dividends. So just keep that Texas videos, Texas vids, TXSVID. Just keep that with you. It's a really, really good way to remember, and if a question comes up in an interview, you got what you need. The other part of options is the Greeks. So the Greeks, what we're looking at here are different Greek letters that we use to denote certain aspects of options. Delta tells you the percentage change in the price of the option given a percentage change in the underlying. So if I tell you that Apple has a call option that has a delta of 80, then what that means if Apple's stock price goes up 1%, the option price will go up 0.8%. If the delta is 60%, that means that the underlying goes up 10%, the option goes up 6%. So the delta is really, really important. And delta can change quite dramatically in different scenarios. And that's where gamma comes in. Gamma is the change in the delta, given the change in underlying. You remember earlier in our class we talked about duration and convexity. Delta is a lot like duration for bonds, and gamma is a lot like convexity for bonds. So gamma is a measure of how much will delta change given how much the underlying changes. And we'll look at some strategies where you'll see why delta and gamma are really, really important. Theta is that time decay. And we're going to come back and we're going to talk time decay here in a little bit. I'll give you some examples. We'll do it in the next session because I want to spend some time on that to make sure you understand it. It's one of the questions I ask on the final that's about 50% of students miss. So I want to make sure we get it. So theta is how much does the option price change due only to the passage of time. That's that time decay. And we'll come back to this, and next session we'll work through that. Vega, it starts with a V, so it makes it easy. Vega is how much will the option price change given a change in the implied volatility, and option prices are quite sensitive to the implied volatility. Rho is the change. Think about the R in the Black-Scholes formula that denotes rates for interest rates, so just think the R for rates. So Rho tells you how much will the price of the option change given a change in interest rates. It tends to be pretty small. Options can be in the money, out of the money, or at the money. So for call options, if the current price of the stock is greater than the strike price, the call is in the money. So like with Apple, Apple is trading for $270. If the current price is greater than the strike price, so if $270 is greater than $250, the option is in the money. We saw that with Apple here. Let's see if I can get back to Apple. So you notice that everything in the blue means in the money. Everything not in the blue and the white means out of the money. And why is that? Well, the way to think about that is, would you execute this option right now? Would you execute an option to be able to buy Apple for $260 if it's trading for $270? And definitely you would do that. That's a $10 gain. Would you execute an option for $280 to buy Apple right now today if Apple is trading for $270? No, you wouldn't. You would just go buy Apple for $270. So in the money means you would execute today. The other thing we're going to say in the next session is that means it has a positive intrinsic value. If it's out of the money, its intrinsic value is 0, and all of its value, all of this $28 is time value. So we'll talk about that. With puts, it's the exact opposite. For puts, if the strike price is less than the current price, it's out of the money. So think about it. Would you execute this? Would you sell Apple for 260 bucks when the current price is 270? Well, no, you wouldn't do that. Why would you sell something for 260 when it's currently worth 270? So that's out of the money. Here's one. What if it's 280? Would you execute this option? Would you sell Apple for $280 when the current price is 270? Yeah, you definitely do that. So this is in the money. So everything in the blue is in the money. Everything in the white is out of the money. So if the current price is greater than the strike, it's in the money. If the current price is greater than strike for a put, it's out of the money. If the strike is greater than the current price, that call is out of the money. It has 100% time value. If the strike is greater than the current price, that put is in the money. So current price greater than the strike for puts is out of the money. See, it's just exactly the opposite. And I'm going to give you a formula so you'll actually be able to calculate exactly this. We're going to be working a lot with the intrinsic value. And when you calculate the intrinsic value, anything other than that is time value. So it makes it really, really simple. If the strike equals the current price, which is pretty rare, I mean, it's unlikely that Apple is going to trade for exactly $270. So today it closed at $268.37. So it's close to being, if you did a 270 option, you'd be close to being at the money, but you're really slightly out of the money if you did that. All right, so what we're going to do next session is I'm going to do some examples of theta and time value versus intrinsic value. Give you a few examples of that so you can practice it. And then, maybe not next session, we'll see. Then we're going to start doing these Excel applications, these Excel examples, so that you can start looking at some of the most popular strategies for options.